Hello friends, welcome to Talent Hub Training Institute FinSolve segment. How are you? Hope all of you are safe and at your home. We know that in this present scenario, many of you want to start your own business. But then you find lots of legal challenges and lots of option is also there. So taking decision is a bit tough. I know. Here we are trying to solve this problem by simple understanding of business-oriented legal compliance. For this, we introduce a video session with different videos. And overall above, from here you can take a certification by completing this session just via online exam. Every video description will provide the link, but we request to all of our viewers first go through all the 8 video sessions, then avail the test for better result, because we will only provide the certification for those who will secure the 60% of marks. So let's start our session.
Today, let us look at the funding and financing options for startups and SMEs. Let us look at the raising of funds. Managing funds is essential for business. Access to adequate money pool often defines the growth for any business. This chapter is about how startups and SMEs can raise funds and the different kinds of options which are available to them. It briefly describes the laws which are to be kept in the mind while availing funds. There are two basic ways for any business to raise money, either as a capital contribution by parting ownership or by raising debt. While each option has its own advantages and disadvantages, there are several factors that define what works best for any organization. Raising capital through equity involves lesser risk and interest-free funds, but it needs sharing of ownership of the business as well as management participation. On the other side, debt comes at a higher cost of interest and may require assets of the business to be mortgaged. Debt financing offers benefits like no ownership transfer and tax benefits as deductible interest expense. Equity finance for private limited company. Let's discuss equity financing specifically for private limited company. Company is the most favored form of business for funding and financing for promoters as well as for investors. Equity financing is the fund raised through issue of equity shares. In this case, the ownership is shared with others. HNI or angel investment and venture capital funding are popular options for raising funds in early stage companies. Some points to be considered. A private limited company cannot issue shares to more than 200 shareholders. The issue of shares to the public is prohibited in a private limited company. The shareholders will enjoy voting rights. Hence, it will affect the controlling and the management of the company. There are multiple ways to issue share capital and raise funding. Private placement, to issue shares to select group of investors like VCs, angel investors, HNIs, etc. Rights issue. This is a way to raise further funds from existing shareholders of the company. ESOP is a share capital raised from employees of the company, often at a discounted rate. Let's further discuss each option in detail. Private placement. It means the issue of shares to the selected small group of persons. The value of such offer or invitation per person shall be with an investment size of not less than 20,000 rupees of face value of the securities. The money shall be received in any other form than cash. The shares must be allotted within 60 days from the date of receipt of application money. The company shall file the return of allotment with the MCA within 15 days from the date of allotment. Rights issue. The issue of shares to existing shareholders is called right issue. Issue can be raised by passing a board resolution. Shareholders have a right of renunciation. The shares must be allotted within 60 days of receiving the application money. The form of allotment of shares must be filed with MCA within 15 days of allotment. ESOP. Equity shares issued to the directors or employees of the company at a discount or for consideration other than cash for providing their know-how or for providing intellectual property rights or value additions. Such shareholders will not be considered for the limit of 200 shareholders in a private limited company. It must be approved by the shareholder by passing a special resolution. A minimum of 1 year must pass from the incorporation of the company. An employee cannot transfer these shares to any other person. Let us look at the capital contribution in limited liability partnership and partnership firm can raise finance in the form of capital from the partners. The firm can increase its capital from existing partners as well as by introducing new partners. It can be in monetary or in non-monetary form. The non-monetary forms can be like tangible or intangible properties, or promissory notes or contract for services, etc. An LLP and partnership firm has to amend the partnership deed for an addition of partner and increase in capital. This is done through entering into a supplementary deed by paying additional stamp duty. After entering into supplementary deed, an LLP has to file e-form with MCA and partnership firm has to file a form with registrar of firms to intimate necessary changes within 30 days. Debt financing. The fund which is raised by borrowing money from a bank or financial institutions or through other instruments is known as debt financing. The key points to note in debt financing are: borrowing powers are provided to the directors of the company in the MOA and AOA. A company must pass a special resolution at the shareholders meeting if the sum total of money to be borrowed and money already borrowed is in excess of its paid up share capital, free reserves and security premium. Temporary loans from companies bank to carry on the ordinary course of business are not included. Debt may be secured or unsecured by the assets of the company. A fixed amount of interest to be paid on it. A private limited company can avail loan or money only from banks, financial institutions, members, directors or their relatives. Members, directors or their relatives must give a declaration that such provided money is not borrowed money. A return must be filed with MCA for such deposits. In the case of the closure of the company, they have a priority in repayment of the amount invested into the company. Following are the types of debts: debentures, bonds, option available only for a private limited company, bank loans. Debentures. Only a company can issue debentures or bonds. It includes any debenture stock, bond or any other debt instrument issued by the company. A company may issue convertible debentures into shares, which must be approved by special resolution at general meeting. A company cannot issue debentures with voting right. If the company fails to pay interest or redeem debentures, then the debenture holder may apply to tribunal and tribunal may pass an order for redemption of debentures and payment of interest, and every officer in default may be punishable with fine or imprisonment. Bank loan. It is the most preferred way of raising finance for startups and SMEs. Loans can be borrowed with or without security as per the bank policy, and a charge created on the assets of the company must be filed with MCA. A form for modification and satisfaction of charge on fulfillment of payment must also be filed with MCA. Also, an entity can avail overdraft or credit facility or guarantee from the banks for the working capital. A fixed rate of interest is to be paid. It can be deducted as an expense. Other kinds of debts for all business structures. Trade credit. Purchase of goods or raw materials at credit and payable later is trade credit. This is helpful in the requirement of working capital. This credit can be availed without any collateral security, and it is the most preferable mode for startups. Hire purchase. Buying capital goods at installments by entering into a hire purchase agreement. But it is different from simply buying goods at fixed installment. Here the ownership of goods remains the seller's until the full payment is paid off by the buyer. The buyer gets the possession of the goods and the right to use them from the date of the agreement. If the buyer is unable to pay the seller, then the seller can repossess the goods. Factoring. Factoring is an instrument by which a company can sell its receivables of a future date to a person at a commission. The person who buys these receivables is known as a factor, and the company can receive a payment in advance before its due date. Once receivables are sold, the company will not be liable for any bad debts. To conclude, businesses have flexibility in terms of raising funds through debt or capital contribution. However, each has its own advantages and disadvantages. These need to be understood before deciding what works best for your organization. Both debt and equity financing, especially in case of company and LLP, are governed by law and needs certain compliance to be fulfilled. We hope this was informative for you and look forward to seeing you again. Thank you.